Yeah, and can I just start actually and think a little bit about what is happening with the economy? We just talked to the Commerce Secretary about what is happening with the supply bottlenecks that we're seeing in the semiconductor sector. How much of a problem is that going to be as an ongoing issue that we need to think about in terms of the inflation narrative, the inflationary narrative that is currently working its way through the U.S. economy?
I do think it's still going to be a factor that is important for the price level as we go through 2022. There doesn't seem to be a quick solution. So I do expect that prices in a number of goods producing sectors, and especially ones that rely on semiconductors, are going to continue to be high. With that said, inflation is about the rate of change of prices. And so I think the goods producing sector is going to go from, up very sharply on a year-on-year basis to much more stable a year from now. The question around inflation is really more in terms of how much of an acceleration you get on the services side and how tight the labor market is and what that means for wages. So there are definitely some clear risks, upside risks to the expectation that inflation comes back down to something, 2.5% to 3%, which is basically the Fed's view. But I don't think it's as much about goods, and it's really more about services and the labor market.
Well, let's talk about how the U.S. consumer factors into this as well, Jan. I want to point to a tweet from Claudia Sahm, who is over at the Jane Family Institute, previous economist at the White House and at the Federal Reserve. And she says the Fed is not going to have to do as much as the markets think because Congress is doing its best to slam people. The child tax credit was putting $200 billion at an annual rate in the hands of parents in December, zero in January, also letting COVID run wild. And Jan, I know that the child tax credit and the lack of a fiscal impulse this year played into your downgrade in a forecast for U.S. growth. How do you square those two things where we're talking about potentially less consumption, consumers maybe having a little more price intolerance, and also a Federal Reserve that you think could hike at every meeting from March in theory?
Well, there are a lot of moving parts in the growth outlook, and I would certainly agree that fiscal policy is going to be a drag on growth in the short term, basically because the amount of support is being stepped down. No more tax rebates, no more extended unemployment benefits, and probably no more expanded child tax credit. So that is going to be a drag. On the other hand, there still is a significant amount of recovery that we can see from post-pandemic sort of normalization, especially in the service sector of the economy. And that's been on hold a little bit in the very near term because of Omicron, but we do think that that's still going to be a factor. So where we come out is that the economy is still going to grow somewhat above trend in 2022, and in an environment where many labor market indicators are quite close to full employment, the Fed's probably going to want to slow things down to more of a trend pace. And I think that's still going to require higher interest rates. So we have 4 hikes in 2022, which is consistent with market pricing. But the risks are potentially that they would have to do more. And we think, even on our baseline, that as you go into 2023, 24, we'll see additional rate hikes.
You've got terminal rates at 2.5, 2 3/4. How quickly do you think we get there? You talk about the 4 hikes this year. Presumably we'll have to have more next year because we'll only get to circa 1% this year. Is that going to be enough to get to the point that you're talking about? Where is neutral, do you think, Jan, in terms of where the Fed is likely to get to and kind of think about what is happening in the economy?
Yeah, neutral is always difficult to estimate, of course, and there are a number of estimates out there. The Fed's estimate is 2.5 in nominal terms, or 0.5% in real terms, and we have a similar estimate. So, I think there's a reasonable case that maybe you go a little bit beyond that if the labor market continues to improve and inflation is still somewhat above the longer-term 2% target, which is our expectation. But it's obviously going to depend on the data. There's not going to be a sort of preset plan to get to a particular level, nor should there be. The Fed will need to respond to the incoming information on the economy and on financial conditions.
And when we look at that incoming information, is it going to be wages that is critically important, Jan? And do you think we are either on the precipice or already in a wage price spiral?
Well, I think wages are definitely an important issue for the inflation outlook, as we discussed. I think the question is, what do wages tell us about where output and employment are relative to potential? We've seen some very rapid wage increases in the last couple of quarters on a sequential basis, quarter on quarter annualized. Our estimate is that that's between 5 and 6, but that's been between 5 and 6%. But there are also, I think, some reasons to believe that maybe some of this is more temporary because of one-off retention bonuses and things like that. Until the end of the summer, you still have the expanded unemployment benefits, which we think had an impact on wage growth at the bottom end of the pay scale. So some of these things, I think, are going to be normalizing. We should see in our forecast somewhat slower sequential wage growth as we go through this year. But I think it's one of the key questions over the next 6 to 12 months.
Yeah, and the phrase I hear at the most at the moment is threading the needle. Everybody talks about the Fed threading the needle. Do you think the Fed is going to have to choose ultimately, and I think this is relevant to what you just said about wages, do you think the Fed is ultimately going to have to choose between tackling inflation and growth? And which side do you think they're going to come down on? Do you think they're going to be prepared to tolerate a little higher inflation just to maintain the growth level, to try and keep people employed and see wages going higher? Where do you think the balancing act lies? And do you think the Fed is going to be able to, now that hackney phrased again, thread the needle?
I do think it's, threading the needle. I think that's a reasonable way to look at it. They have a dual mandate on both inflation and employment. And so they're going to want to put some weight on both. They would like to bring growth down to more of a trend pace and thereby, stabilize measures of labor market slack before you get clearly past full employment. And I think that's going to be the goal. I don't think we're necessarily so far away from that. I don't think we need a very aggressive tightening of policy to get to more of a trend growth pace, especially if financial conditions, continue to tighten. We've seen some tightening in financial conditions, hasn't been very big so far, but I think that is ultimately probably necessary to see a slowdown to more of a sustainable growth pace.
Well, Jan, I'm glad you brought up the tightening of financial conditions, because our question of the day today is if the volatility we've seen in the stock market, the sell-off we have seen, creates a problem for the Fed. Do you think it makes their job easier or harder down the line?
I think it is what usually happens when you see a change in direction on monetary policy. I mean, a few weeks ago, I think you would have said it's been surprising how little impact we've seen on the equity market from the shift in the near-term monetary policy outlook. So now we've had obviously some very volatile days, and you wouldn't say that anymore. But I would still say that overall financial conditions, while tighter than they were 4 weeks ago, still haven't tightened, so much that the Fed would want to abandon the idea of a March rate hike, for example. We're not close to that, in my view.
Yeah, and can you just give me your thoughts on how we should think about hikes versus balance sheet runoff? And it's not one for one, and I don't know how you should think about it, but can you just explain your thinking around how you're trying to work out this problem about what effect runoff is going to have and how does that compare with rate hikes and what the Fed is going to be thinking about around this issue?
So our expectation is that they are going to rely predominantly on rate hikes for normalizing financial conditions and the stance of policy, and the balance sheet runoff occurs in the background and is much less responsive to new information about the inflation outlook or the growth outlook. So it's not quite autopilot, because of course, if there are large changes, then the balance sheet policy could be revised as well. But we don't think that's nearly as activist. We also think, based on our estimates of the translation of balance sheet size or asset holdings into financial conditions, we don't think there's going to be a very large impact from the balance sheet adjustment. Most of the impact on financial conditions, based on our estimates and the academic literature that has looked at QE and its impacts, really says that it's more interest rates and the policy rate and the funds rate.
Jan, we only have about a minute left, but market pricing already has come quite far in terms of expectations for future Fed policy. What do you think would be the biggest hawkish surprise that the Fed could deliver today?
Yeah, I wouldn't expect necessarily large hawkish surprises here. I mean, in theory, they could say we're stopping QE right here. That's something that has been talked about. They're still currently signaling to go and end only in March. They could do that, but we don't expect them to do that, just based on what we've heard from FOMC members. Chair Powell in his confirmation hearings, for example, was asked about the QE program, and he said it would end in March. So it would be a surprise, but I would not expect that. I think, otherwise, the tone of how they talk about the inflation outlook, obviously, is going to be important, and there's always going to be something for the hawks and the doves. But I wouldn't expect a very disruptive type of communication. They're trying to get ready for the normalization.